Let's talk about CMBS loans, what they are, how they work, and why they matter in the commercial real estate business. You may have heard of the term mortgage-backed securities, and if you've seen the movie The Big Short, that's what that whole movie was based on, except it was focused on residential mortgage-backed securities. And so CMBS is the commercial version of that. It's a commercial mortgage-backed security. My name is Brandon Avedikian. I'm the founder of Aspire Commercial, a commercial real estate brokerage and property management firm based in Houston, Texas. We help owners of commercial real estate buy, sell, lease, and manage property, and we help tenants find the next space that's ideal for their business. Be sure to hit the subscribe button if you want to learn more about commercial real estate, business, and entrepreneurship, and be sure to send this video to anyone who's looking to learn more about those same topics. So let's get into CMBS loans. A CMBS loan is a loan that gets packaged up with a bunch of other loans and then sold to investors as a bond. And so let's walk through what happens. You borrow money to buy or refinance a commercial property. The lender, instead of your lender keeping the loan on their books like a normal bank would and collecting your payment every month, the loan gets bundled together with hundreds of other loans, and the pool of loans gets sliced into pieces based on their risk profile called tranches, and those tranches get sold off to investors as CMBS loans. And so if you don't understand the difference in this structure versus traditional bank loans, it could come back to bite you, because while there are benefits to CMBS loans, there are also downsides. The first downside is there's no relationship attached to the loan whatsoever, because your lender doesn't actually hold the loan. Once the loan closes, it's gone. It's sold off, pooled, securitized, and handed off to servicers who have nothing to do with the original underwriting and issuing of the loan. And so later on down the road, if something comes up or something goes wrong, you can't call the lender you have a relationship with and work through it with them. You're dealing with a third-party servicer who had nothing to do with the loan being issued to begin with, and they're managing hundreds of loans, and they frankly don't care what you do or say. They are there to service the loan and collect your payment, not work through issues with you or provide you with any sort of flexibility. And that leads into the next downside of CMBS loans is they are way less flexible than traditional loans. With CMBS loans, you usually cannot pay off the loan early without paying a massive prepayment penalty, which is called defeasance or yield maintenance. And so if you get a CMBS loan on a 10-year term, you're pretty much locked in for that 10-year term, unless you sell the property to someone that will assume the CMBS loan. And so why in the world would anyone in their right mind get a CMBS loan? Well, there are three big reasons. The first reason is they are non-recourse loans. And so as the borrower, you don't have to personally guarantee the loan. And so if you get a CMBS loan and your investment fails, you're not on the hook personally. Now, there are exceptions to this, and it's called bad boy carve-outs. And a bad boy carve-out simply means if you commit fraud or do anything untoward or violate the loan documents in any major way, the non-recourse loan can turn into recourse. But as long as you are above board, honest, and don't commit fraud and do what's in the property's best interest, they are non-recourse loans. They are also typically higher leverage. CMBS lenders will often allow for a higher loan to value than a traditional loan will, and so you can get a higher loan balance, which requires less equity, and if the investment goes well, that can help boost your returns. And third, they often have lower interest rates than traditional bank loans. And so if you're buying a property and plan to hold it long term, or don't think you're going to have any issue getting a future buyer to assume the loan, it could be a good fit to get a CMBS loan. But if something goes wrong or the investment starts to go south, the loan is going to get transferred to what's called a special servicer. And let me tell you, special servicers are not logical thinkers. They don't care that you've made every loan payment on time for the past 6 years. They don't care about your business plan or your reputation. They don't care what your plan is to fix whatever the issue was that caused the loan to get transferred to them. They are rule followers, and in many cases, they are financially incentivized to foreclose on the property, not work with you, because often they generate more fees by foreclosing on the property. You are nothing more than a loan number in a giant pool of paper to special servicers. And so if you think you're going to be able to call someone, explain your situation, and work something out, you are in for a very rude awakening. And that is the main risk with CMBS loans, is the lack of flexibility and absolutely no relationship being involved in the loan. And so are CMBS loans good or are CMBS loans bad? Well, neither. They are a tool. They are not inherently good or bad. Sometimes they may work for an investment strategy, sometimes they may not. And so the main takeaway here is if you're going to consider a CMBS loan, make sure you know what you're getting into. I could tell you horror stories of people that got CMBS loans that it ended very bad. I could also tell you stories where CMBS loans worked out great. So just understand what you're getting into, compare the pros and cons of a CMBS loan to traditional bank loans. Let me know in the comments what questions you have and what you'd like to learn about next. Thank you for joining, and be sure to subscribe for more commercial real estate breakdowns and educational content in plain English.